Gents, just before we went to break, we were chatting about M&A activity. We're looking on a global scale and what some of the moves were there. Bringing it to South Africa, Riaz, do you think we could see some M&A activity in South Africa? Of course, we know that HSBC has stepped back from buying Nedbank. Do you think we could see more interest in the South African banking sector?
I think definitely so. South Africa offers a stable banking environment, which is very attractive to foreign buyers. So I think you're still going to see a lot of the HSBC type of forays into Africa. Barclays, as well as the Chinese banks, have already put their money where their mouths are. I think you're going to see a lot more of that here in South Africa, definitely. So
what do you see as the attraction of the South African banking sector? What are the drivers of that M&A activity going to be?
I think first, South Africa has a well-established control and governance environment in terms of regulation from our Reserve Bank. So the international world actually tend to find that quite attractive. We also have to take into consideration that South Africa specifically is a good base to expand into Africa. And most companies globally, they see South Africa to be the first place to actually land and then grow into Africa.
Would you agree with that, Louise? As an outsider looking in, do you think that South African banks look attractive, that they do have that access to Africa and also to those African-Asian trade flows?
I think it's completely there, and taking also, if you think about big banks, and most of them, all of them are trying to apply regional models. If you think about that, then South Africa would probably be one of the perfect place to find a hub to actually execute a regional model across Africa. So definitely yes.
Perhaps just looking at how banks should be positioning themselves going forward if they are going to be successful. And of course, Accenture has come up with the new banking virtues. So that's 5 key levers to rebuilding profitability. So perhaps starting with those strategic cost reductions. And you talked about this a little bit earlier. The difference between strategic and tactical cost reductions, can you explain that?
By strategic, what we're talking about is long-term cost reductions. As Louise mentioned earlier, it needs to be sustainable, it needs to be applicable for the now, and it needs to be applicable for the future. So when examples of strategic cost reduction would be changing your lending process to be a lot more efficient, a lot quicker, and a lot cheaper. I think the key going forward is lowering your cost to serve. I think it's not only pertinent to the banking industry, it's applicable to other industries as well. If banks can lower their cost to serve, that means that they can offer lower cost banking to their clients. And those changes need to be long-term changes, not short-term.
Does this come through simpler products? Because of course you spoke about Capitec, which is a low-cost bank. It does have very simple products. Do banks need to look at the products that they're offering customers and simplify them, Thabo?
As I said in the beginning, I think going forward it will be less of the product. It will be a lot more the focus on the customer itself. For example, multi-channel integration or distribution actually of products via multiple channels. And we've spoken about mobile devices, we've spoken about self-service kiosk, and obviously the old-time internet. More customers now are wanting to access the bank a lot more quicker, a lot more simpler. The product themselves, they tend to be pretty much the same. Pricing obviously will be a differentiator going forward, but it's more the price to actually serve, because most of their cost for most banks actually sit on the price to serve.
Have we seen banks successfully implementing such a strategy globally, Louise?
In terms of
simpler products, better pricing,
definitely
multi-channel distribution.
Definitely, there's examples. The thing is that most banks have such a legacy in terms of process and in terms of systems that it's not easy to do it. But there have been banks that have been transformed to do this, and it requires transformation from the business to your operations, and of course, ending in the technology.
How do you break out of these legacy systems, though? It must be pretty difficult and pretty expensive, I'm sure.
It's not an easy task, but if you talk about how you're going to be forced to do it, you're actually going to have to come up with a lower cost to serve. And if you really want to tackle that, you're going to have to do it. So actually, the sooner you start, the better. It's really a question of, can I survive without doing it? Perhaps some years ago you could say, well, banks could do it. It's become the time when you're not going to be able to survive if you don't do it.
Robust customer management, and that's pulling customers rather than pushing products. How do you go about that, Riaz?
I think that goes back to the discussion we had earlier about building customer trust again. I think it may not be as applicable in South Africa as it is in Europe and North America, but certainly trust has been eroded, and banks need to keep to their promises. And I think, again, pricing is key. Pricing is going to drive a lot of buying decisions, if I can call it that, in terms of customers coming into the bank. And by providing attractive products, simple products, efficient service at a lower cost, that's going to pull the customers back into the banks.
How do you bring those costs down for customers without eroding your margins, though, Thabo?
As Reza mentioned earlier, there has to be some strategic investments in cost-cutting exercises, which are very strategic in nature. For example, there are many components of the bank that are repeated, or should we call it business processes, that are repeated throughout the bank. Risk management is actually one of them, which could be actually integrated, where risk management is actually centralized. It's managed from a central point of view. That will reduce the cost and be able to actually pass that cost cost reduction to the customer.
Of course, risk management is key at the moment, and of course we have seen quite robust risk management in South Africa within the banks, but things still slip through the cracks. So globally, how do you see it at this stage?
I think risk management has been the key. I hate to go back to Santander as an example, I think it's one of them. When you talk to them and you ask them, well, what's one of your main strengths? They actually say, well, it's really risk management. So they try to export the model to other places and countries around the world. They really concentrate on risk management. It is really key in achieving results.
And of course,
I just wanted to mention one thing around client-centric and client-centricity and banks. I think most of the banks talk about being client-centric, and the issue is that most of them are not really organized, and they don't really operate as that. So they work more and operate more as a product-centric view, even though they are strategic, they say that they're client-centric. I think that's where the banks have to do an effort. They have to make the change and say, well, I want to be client-centric, I have to operate as client-centric.
Because they have to be client-centric, but at the same time they have to deliver returns for shareholders in most cases. And we've seen ROEs coming down significantly from a few years ago when we had ROEs in the mid-20s, now in the low to mid-teens. Where should banks be aiming for? Do we have a new normal for ROEs going forward, Riaz?
From the research that Accenture has conducted, we believe that high-performing banks will probably end up at an ROE close to 15%. Obviously nowhere near the 2000 to 2007 range where ROEs, as you mentioned, were above 20%. But in order to get from the lower, not teens, below teens, to the 15% range, that's going to take strategic initiatives to drive it upwards. And that's where better pricing comes into the picture, innovative products, winning customers back into not only your branches. I think the branches are going to start playing a less significant role, but through other channels like the cell phone, the internet, and any other channels that may become available over time.
We're also looking at branchless banking, perhaps, Thabo.
There is a drive to encourage customers to transact with banks outside the branch network, even though it's quite significant for the traditional bankers or even the traditional customers, for that matter, to have a branch. But there is certainly a drive to encourage customers, charge them less for them to either interact via ATMs, via internet, via mobile devices. And what I think we're seeing going forward is that there is a target for the younger generation via social media or social networking, where I think that banks need to play a greater role going forward, because they are the customers of tomorrow.
Would you agree with that? Is that something we can look at globally as well, with more interaction on social networking sites, less branch interaction?
I think you're definitely going to have less branches, and also the branches are going to be dedicated to something very different. So perhaps when we talk about at the beginning about retailers and telcos, I mean, banks have tremendous commercial space in terms of the branches, and very spread all over countries that they operate. I think that has tremendous commercial potential. So branches should be really for selling. And so I want to see less branches, but completely sales oriented, and also mixed with commercial activities around perhaps telco, perhaps retailers, perhaps other type of commercial activities.
Are we using things like supermarkets enough, Riaz? Because this is something you see quite a lot in Europe, where you actually do most of your banking in the supermarket. You get cash back when you go shopping. Do we utilize supermarkets enough here?
I think we are seeing the utilization of supermarkets. We're seeing the proliferation of ATMs as a very important channel to deposit and withdraw cash. So I think we are using supermarkets. We can probably use supermarkets and other retail businesses a lot more. And I see that business model evolving as well. So it's not only supermarkets, it's your telcos, it's your petrol stations, creating agent networks for mobile banking. And that agent network could embrace your corner shops, your petrol stations, etc.
Of course, we mentioned, Tabu, Africa as a driving force for growth and M&A activity. How about Asia? Do you think we could see some African players making bigger forays into the Asian market, because that's also one of the big growth markets of the future?
I think it's less likely for us to see African operations expanding into Asia, but I can see a lot more of the Asian operation expanding into South Africa, as we have seen an Asian shareholdership in Standard Bank and HSBC coming through for Nedbank. And also, we've just seen Dimension Data recently being acquired by an Asian company. So I think we'll see a lot more Asian companies coming into Africa, because it's still the land of promise in terms of expansion and growth and potential. And so we'll definitely be seeing a lot more acquisitions taking place in Africa.
Gents, I'm afraid we're out of time. We have to leave it there. Thanks all very much for coming in this evening.